Hello everybody, this is Eddie Gabor, owner of Key Advisors Group. Please subscribe to our YouTube channel for up-to-date market takes, our opinions, as well as some educational videos that we will push out from time to time. Today I wanted to take some time to discuss this bear market rally, or at least what we believe is a bear market rally in the month of July. This market rally has started to raise some eyebrows, and people have been asking us, which is why I'm shooting this video, if our stance has changed into regards to our market call. We've been one of the few firms since the month of December that has been very clear that we felt like the path for this market for 2022 was going to be downward. And we knew it wasn't going to be a straight line down. It usually never is. And these bear market bounces will cause people to second guess themselves. It will also cause firms to flip-flop from bearish to bullish to bearish to bullish, and we've seen that this year. Just look at the March bounce. I remember in the March bounce, I was on Fox Business, and they were asking me if the bottom was in, and many people at that time thought the bottom was in because of 50-day moving averages and other charts that they look at. And we continue to be very, very consistent, and this hasn't changed. That we felt like the economy was going to continue to deteriorate over this calendar year due to inflation and other things that we are going to go into in this video. And that's why we continue to be very, very bearish. Let me be crystal clear. This July bounce has not changed our stance. And the data that we've gotten from earnings, even though the market is rewarding these earnings calls, is actually confirming with even stronger conviction that in our opinion, we think we're going to test the lows that we saw in June. And if they continue to deteriorate at the pace that we're deteriorating now on the consumer side, it is of our opinion that we will go lower than the lows that we've seen. So unfortunately, we think things are going to get worse before they get better. Make no mistake, they're going to present some amazing opportunities, and I'm very excited about that because I want to be bullish. I hate being bearish, but I get paid to tell the truth and not give some narrative just because it fits what I want it to be. If the narrative is bullish, but I see things that are bearish, I'm going to disagree with that. And that's where we are right now. So let's talk about it. First, let's talk about the Fed. We keep getting this question here in narrative, oh, the Fed is now dovish. The Fed has increased rates and tightened monetary policy at the fastest rate in history during one of the fastest slowdowns in economic history. In the fourth quarter of last year, we had a GDP print of approximately 7%. Now, we just got a negative GDP print. So within 6 months, we went from what was perceived as a robust economy to an economy that is potentially in a recession. When you slow down that fast and you tighten that fast during that slowdown, it is of our opinion that that could really shock the system and not feel that repercussion till later on. Because keep in mind, when the Fed raises rates, you don't feel the potential damage or repercussions right away. It takes months for that to happen. And we're seeing that happen in our opinion. So the Fed is not dovish. This is the most hawkish we've seen a Fed in a very, very long time. And they've made it clear that they're more than likely going to raise rates again in September because they're looking at the labor market and inflation. Even though they may trend down, it is of our opinion, it's not going to come down to the point where it's a level that is good for the consumer. So is the Fed going to jeopardize their credibility again and change their mind by not increasing rates? Even though we don't agree with how aggressive the rate hikes are, the bottom line is they're telling us what they're going to do. So until they prove otherwise, we're going to go with that. And so we think they're going to raise rates again in September and continue to damage the economy. Number two is the dollar. As the Fed continues to tighten, the dollar stays strong. These multinational companies are taking a hit because of the dollar. So that currency strength in the US dollar is going to continue to put profit margins in a compression mode. And that was very consistent with these earnings calls of these multinational companies. Yet some companies continue to say guidance is just going to be fine in the coming quarters. We'll wait and see if that actually comes to fruition or if they guide down just like they did last quarter. The third thing is, let's talk about these bear market bounces. I was managing money during the 2000 tech bubble burst, during the 08-09 Great Recession, and those are the two best examples I can give you from our career. In both of those markets, investors throughout that entire cycle, if they stayed fully invested, lost a big chunk of their portfolio. There were great companies that went down substantially during that time period. But during that time period, which was a bear market, you saw some bounces that were over 20%. Think about that. Investors now are worried about a 10 or 12% bounce that we've seen. Bear market bounces are very, very vicious, and they're very, very common. So these bounces, frankly, should be expected in a bear market and shouldn't sway your opinion because of 1 or 2 week rally. Now, if you think that we're not going into a recession and you think the consumer's strong and you disagree with our take on the economy, I respect that, and you have to do what you think is best for your dollars. I'm just sharing with you what our thoughts are and why we continue to be bearish. Now let's talk about the consumer. This consumer continues to show signs of weakness, and I can't stress this enough. We are in the beginning stages of that. AT&T and Verizon just came out with earnings, and they talked about in their earnings call that customers are starting to pay their cell phone bills late. Think about how important a cell phone is to families today. That's a pretty essential thing for them. So if they're starting to pay that bill late, that is a big warning sign for us. We're starting to see credit card debt increase. We're starting to see 30-day payments increase, 30-day late payments, that is. We're also worried about the auto loans and anyone that has exposure to auto loans. This consumer is really starting to show signs that they're having a hard time paying bills. Walmart, and I can give you example after example. Walmart, during their earnings call, talked about how the consumer is going and buying their biggest asset they're buying now inside of their stores are consumer staples, things like groceries. Their apparel inventory continues to increase because the consumer is not spending as much money on these discretionary items. And you can look at just about any retailer and they're seeing that. You're seeing inventories rise because the consumer is not spending as much money as they were last year. I mean, after all, how can they? With the price of gas, the price of food, the price of rent and housing, how can the consumer have as much discretionary income as they did last year? And I can't stress this enough. They've held on as long as they can. They're blowing through their savings. And now we're at a point where there's late payments coming in. And this is usually the early warning signs. The next thing is real estate. Real estate is the one major asset that really hasn't rolled over yet. And we are now finally starting to see signs of softening. Mortgage rates have increased substantially over the last 45 days. And we're starting to see around the nation inventories increasing slightly. We're starting to see houses on the market for a longer period of time. We're starting to see prices come down. And we're seeing builders putting out more incentives to get buyers to come in. And we're starting to see the traffic start to get lower in regards to the housing market. Companies like Redfin have been laying people off due to the concerns in the real estate market. Again, these are just the very early signs before you start to see prices coming down. Now, we don't think we're going to have an 08-09 crash in housing because the mortgages on the housing today are much different than what they were back then. But because we believe we're going into a recession, we don't think housing is going to be immune to it, so it's going to be soft, and we're going to see deceleration on real estate. Again, something that is very problematic for the equity markets. The next thing I want to touch on is the bond market. There's a saying in our industry that the bond market is smarter than the stock market, and I happen to believe that. Not everyone does, but I do. The 10-year and 2-year yield is inverted at a level that we haven't seen since the 2000 tech bubble burst. So let that sink in for a minute. Right now, there is a debate between the bond market and the stock market. Bond market is raising some major red flags. It's not just the inversion of the 10s and 2s, it's the high yield spreads. So during this bear market bounce, high yield spreads have stayed wide. If we were going to get some clear signals that things were getting better, we wouldn't see the yield curve continue to invert, in our opinion, and we wouldn't see high yield spreads staying wide and even widening. So the bond market is saying something completely different than the stock market. And we're very concerned about the outlook that the bond market is portraying for this economy. So when we look at the consumer and the data that we see deteriorating there, we look at the dollar, we look at the Fed, we look at the inversion of the yield curve, we look at high yield spreads, and we look at all these earnings that came out. If you read the small, fine details, not the headlines for people to click on a button, the warning signs are there. And one of the toughest things as an investor to do is to stay disciplined and not chase these rallies. We as a firm are sitting on a very nice cash position for our clients, and we do not plan to jump into this rally because we do not think the bottom is in. We think we're going to test new lows because we believe the Fed is going to continue to tighten, and we believe that this economy is going to continue to deteriorate, unfortunately. So we expect GDP to continue to be negative in the coming quarter, and we think as each month goes by, the consumer is going to show more and more signs that they are hurting financially. And the last thing I want to touch on is the wealth effect. There's this misconception that those that are wealthy won't change their spending habits. And that may be true for some. But if history has proven anything, the wealth effect is real. And when you lose a tremendous amount of wealth as a nation, that impacts not just those that live paycheck to paycheck, but also the wealthy. If someone is sitting there and they lost a third of their assets and their house goes down by 20% and they feel like they're in a recession, they are not going to invest the way that they would have when things are looking very prosperous. So look, it is of our opinion that right now is not a time to be jumping in and get sucked in to this bear market bounce. But it's a time to be patient and wait for opportunities. Some of the best opportunities come when bubbles burst. And in our opinion, that is what's happening in 2022. And for those that have money left when this is all said and done to be able to buy this dip, in our opinion, will be handsomely rewarded. Now again, this is just our opinion. This is not what we're telling you to do with your money. This is just us educating you on what we're doing with our client assets and the reasoning why. I want to educate you and hopefully empower you to make decisions on your own for you and your family, for what you think is best for you and your family, based on what you think this economy and market's going to do. So instead of just making a decision based on emotion or what a headline in the news says that day, dive into the details. Listen to the earnings call. Listen to the things that they're telling you that maybe isn't going to get a headline that could impact your decision on where you think the best place is to park assets. So I want to thank you for your time. I hope you found this video to be educational, and more importantly, I hope you find it to be actionable for you and your family. So I hope you all make this a winning week, and thank you for watching.